So we are starting with chapter 3rd of standard 12 secretarial practice, that is debentures. So in the previous chapters we had learned about shares. Now shares and debentures are similar in the sense that when the company wants to collect capital, for example, it wants to collect large amount of capital, it wants to collect 2 crores. So what they will do is, instead of asking this 2 crore from a single investor, they will divide this 2 crores into shares, into small parts of say 100 rupees, and then they will issue 2 lakh shares of 100 rupees each and ultimately collect this 2 crores. Now similarly in debentures also, in debentures when the company want to take a loan, so instead of taking this loan from a single bank or a single financial institute or a single person, what they will do is they will divide this loan into small parts. For example, they want to take a loan of 2 crores, so they will divide this 2 crore into 1000 rupees each debenture, and then they will issue these 20,000 debentures. I think it will be 20,000. So it will be divide this 2 crore amount into 20,000 debentures, and for 20,000 debentures they will collect 1000 rupees for each debenture, and ultimately will be able to collect 2 crore rupees. So these are all so concept wise shares and debentures are quite similar. Now the difference is that shares are owner's capital. That is, when you purchase a share, you will become the owner of the company. But when you purchase the debentures, you will become the creditor of the company. So debenture, in all the definitions, we are seeing one thing in common. We are accepting that debenture is a document. So whenever if you go for taking a loan also, what they'll first do is they need a proof that they are giving you money and that you will be repaying the money. So they will always make you sign a document. Similarly, in debenture also, they will have a document in which it will be accepted that I am taking loan from this particular person and I do accept to repay the loan. So in all definitions, you'll have one thing in common, that it is a document in which you are acknowledging the debt. Acknowledging means accepting. So you are accepting the debt in this document, and now anyone can issue a document or a paper in which they can write that okay, this company is accepting my debt, but that document has to be authenticated. So how it will be authenticated? By using the common seal, that is by affixing or stamping the paper with the common seal. So there are two aspects. It is a document acknowledging the debt, and second, it should have the common seal of the company. So the first definition is by Sir Francis Palmer. Debenture is a type of document issued under the common seal of the company acknowledging the debt. Now the second definition is a bit more elaborate. In this we are talking about multiple things. First thing is, it is a document in which the company is accepting the debt. Second is, the document should contain the common seal. Now while accepting the debt, what things have to be mentioned in the document? First, when will you repay the amount? That is, you have to mention that I will repay it after 15 years or after 20 years. Next is, at what rate? So the company can say that after 15-20 years, when I am actually repaying the amount, I will give you a premium of 20%. For example, if the debenture is of 1000 and company says that I'll give you 20% premium, so I'll actually repay you 1200 at the time of maturity at the end of 15 years. Or it can be at the option of the company, that is, after 15 years the company will decide at what rate they will give the premium. After 15 years they will be saying that we are giving a premium of 5% or a premium of 30%. Now this is the part where you are talking about maturity. Now during this period of 15 years, 20 years for which you have held debentures, for that period also you will be getting some return. For that period you will be getting some income. This income will be in the form of interest. For 15-20 years you will get an interest, And in the debenture document, it will be mentioned what will be the rate of interest and when you will get the interest. That is, it can be quarterly. Quarterly means once in 3 months. It can be semi-annually, that is once in 6 months, or it can be annually, that is once in a year. So you have to mention the rate of interest and the interval at which the interest will be received. So a document containing acknowledgement of indebtedness, that is acceptance of debt, issued by the company under its common seal, and given an undertaking to repay the debt. So there has to be mentioned that I'll repay the debt at the end of 15 or 20 years at a specified rate or at the option of the company. So here we are talking about when I'm repaying the debt, how much premium will I be giving, whether it is pre-decided at the time of issue of debt or it will be decided by the company at the time of repayment of debt. And in the meantime, that is during this 15 or 20 years, to pay interest. So if for 15 or 20 years you will be getting interest thereon at a fixed and at interval stated in the debentures. So the rate of the interest will be mentioned and at what interval the interest is given is also mentioned. Now let us see the type of debentures. We have four types of debentures: mortgage debentures, fully convertible, partly convertible, and non-convertible. So in mortgage debentures, what happened is the company is creating a charge, or it is actually mortgaging assets of the company. Now this happens in all types of loans. Like for example, if in a home also, when we have taken a home loan or a car loan, so when we take a loan from the bank, what the bank will do is they will mortgage our home. They will give us the money, but they will mortgage our home. So in case we are not able to repay the amount, we are not able to repay the loan amount, then what the bank will do is they will confiscate our home and they have the right to sell off our home and recover their amount. At when we pay off our loan completely, at that time they will cancel that mortgage, or they will release the assets which are under mortgage. So this for this two words can be used. You can either use the word of mortgage or you can use the word charge is created on the asset. So in the case of companies also, the banks do take a mortgage. If you are going to a bank, they will also ask some assets to be kept as mortgage. They will ask assets on which charge has to be created. Similarly, so when debentures are also issued, because debenture is also a form of loan, so the company can say that I am creating a charge on my assets. So if anything happens to my company, if my company is getting closed down, these assets can be sold off and the debenture holders can be repaid. Now this charge can be of two types. It can be fixed and floating. With fixed we means that the assets which are mortgaged or on which charge is created has been specified. There are specified assets. For example, my factory has multiple factory sites. My company has multiple factory sites. Now there are three factories which is in northeast. So I can say at the time of issue of debentures that I am mortgaging my three factory sites which are in the northeast. They are at Shillong and at this address, or Tripura at this address, and Bengal at this address. So the company can say that these specific three factory sites I will be mortgaging for my debentures. So this is a fixed charge. Now if any problem happens with the company, these three factory sites will be sold off and the debenture holders will be paid their money. Floating charges, it is a general statement that I am creating a charge on all my assets. So it's not just these three factory sites, even for other assets also, they can be sold off and given to the debenture holders. Now next is fully convertible debentures. In fully convertible debentures, if I am purchasing debenture of 1000 rupees, at the end of 15 years or 20 years, what the company will say is, I'll do one thing, you have paid me, you have bought a debenture of 1000 rupees, plus I'm declaring a premium of 20%. So I'll issue shares of 1200. That is, they will not be giving me cash back Instead, they will be issuing me shares at the end of 15 or 20 years of the same value. Partly convertible debentures, in that also, if they are supposed to repay me 1200 rupees, so they will say that 40% we will issue to you in the form of shares, and remaining 60% we will give you in the form of cash. And in non-convertible debentures, I won't be given any option for shares. The company will only repay me in cash. So in this second, third and fourth, fully convertible, partly convertible and non-convertible, the company is actually repaying the amount. The company is giving the amount, but in some cases, the company is repaying in the form of shares, and in some cases, it is repaying in the form of cash. Next is procedure of issue of debentures. So just like shares, we have a long procedure for issue of debentures. So first procedure is, whenever we want to do any action, first we have to take a decision to do that action. So who will take the decision? The board of directors will take a decision. How will they take a decision? By passing a resolution in the board of directors meeting. Next is, because this is debentures, we are taking a loan, and the repayment of this amount, the payment of interest will be a huge burden on the company. So we have to take the permission of the shareholders also. So whenever the amount of debentures or the amount of this debt increases is more than the amount of free reserves, then you have to go to the AGM, that is annual general meeting. You have to take the permission of the shareholders. After you get the approval of shareholders, if the majority of the shareholders agree to take this loan, only then you can issue the debentures. Now, what is free reserves? Free reserves is, we learned in the share dividend part also, that whenever company earns a profit, suppose it earns 100 crore rupees, then it has the option, it will analyze that, okay, for my future I do need 60 crore rupees, so I am putting 60 crores in my reserve. Now, these reserve can be made for multiple purpose. For example, the company may create a reserve for repayment of a particular loan, or it may create a reserve for a specific purpose. Or there are some provisions of the Companies Act also, or the provision of the SEBI also, which mandates, which makes it compulsory to create certain percentage of reserve. For example, when you have this non-banking financial corporations, like we have Bajaj Finance and such institute, they are given guideline by RBI that they cannot give 100% amount as loan to their customers. Whatever profit they are having, they have to give some part of it as a reserve. So this is a mandatory or compulsory reserve which is created. So other than this, whatever reserves you have, it is free reserves. These reserves which are created by a compulsion of the law or for a specified purpose are not free reserves. Other than this, if you have any additional reserves, then that will be considered as free reserves. If your debenture exceeds the free reserves, then you will have to take the permission of the shareholder. Next is, you have to take the permission of SEBI. You have to follow, there are so many provisions given in the Companies Act. You have to follow those provisions. You have to follow the guidelines of SEBI, and after this you also have to take a permission of the SEBI also for issue of debentures. Next is to issue prospectus. So because we are collecting this amount from the general public, so we'll have to give the information to general public about what the company is doing, what is the current status, what are the future plans, how it will be using this amount, etc. So it's sort of an advertisement to encourage people to subscribe for the debentures. So for this, they will issue the prospectus. Next is appointment of trustee for debentures. So here we saw in the mortgage debentures that a fixed charge or a floating charge is created on the assets whenever you are issuing the debentures. So now suppose there are 10,000 people who have subscribed for your debentures, and you have said that I have 3 factory sites which I am giving as mortgage for this debentures. Now suppose something happens to these three factory sites. Suppose the company decides that okay, I'll close down this factory sites because I'm running into loss. Or suppose there is a natural calamity because of this, one or two of these factory sites have been destroyed. So that many things may happen because it is a long term loan. It will go on for 15 or 20 years. So how will you safeguard your asset, or how will you ensure that these assets which have been given as mortgage are capable of being sold off and you will be able to recover your amount in case there is a natural calamity and one of the factory sites is destroyed? So obviously you cannot sell it and recover the full amount. So in case the company goes for liquidation, the debenture holders will not be able to sell it and recover their amount. So it is very necessary for them to ensure that these assets are safe. Now there are 10,000 debenture holders. Not everyone can go and ensure that these these assets are safe. For that, they will create a debenture trust. And debenture trust, when you are creating under the Trust Act, you will have to appoint trustees. These trustees are responsible to ensure that the rights of the debenture holders are safe, that these assets on which charge has been created is safe, that the company is working properly, and so the amount which is invested by the debenture holders are safe. So these debenture trustees will be appointed by the company. In the first time the company will appoint it. Subsequently, every year what will happen is the debenture holder also have an annual meeting. In the annual meeting, the debenture holders have the option to choose new trustees, but the first trustees at the time of the creation of the debenture trust will be appointed by the company. So next is agreement with underwriter. We saw at the time of shares also that if the shares are undersubscribed, if sufficient people have not subscribed for the shares, the remaining share will be purchased by the underwriter. Similarly in debentures also, if the debentures are not subscribed, the remaining debentures will be subscribed by the underwriters. To open an account in the scheduled bank, that is, all the debenture holder will deposit their subscription amount in a specified bank. When the allotment is done, only after the allotment is done, they can withdraw, the company can withdraw from this bank, and for people who have not been allotted debentures, their amount will be refunded directly from this scheduled bank. Next is registration in stock exchange. So just like we can transfer shares, the transfer of debentures is also possible. Debenture is an asset, so the person who is holding the debentures can sell off these debentures to another person and they can recover their cash. So for this transaction, these have to be listed in the stock exchange. If for any reason these debentures are not, the stock exchange refuses to list these debentures, it can say that no, the company is not in a very good state, or the company does not have good credit rating, so we will not be listing these debentures. In that case, the entire subscription process of debentures is considered a failure. Whatever amount they have received from the subscribers, they will have to refund the entire amount. Next is preparing of allotment register for debentures. That will make a list of people who have applied for the debentures, what is their name, address, how many debentures they have applied for, and how many debentures you are allotting them. So an entire register has to be maintained, and this list is given to the board of directors for their approval. And finally, debenture certificate. In this, debenture certificate will be issued at the time of full payment of the debentures. For example, the debenture is of 1,000 rupees, then the person has to compulsorily pay the entire 1,000 rupees upfront. In shares, we had seen that he will pay only 2 rupees, he will pay 5 rupees, and the remaining, whenever the company needs, they will go for share call. But in debentures, they have to pay the entire amount at the time of application, also at the time of issue only. For example, at the time of subscription, the company has said that okay, just give me 20% of the amount, that is 200 rupees. But after allotment, you have to pay the remaining 800 rupees. Once the entire amount is paid, only then the debenture certificate will be issued. before that debenture certificate will not be issued. So there is no concept of partly paid debenture or anything of this sort. Now let's see the rights of debenture holder. Now firstly, whatever is mentioned in the debenture document, those all are the rights of the debenture holder. So the first right, what is mentioned in the document is what will be the interest rate, at what interval they will receive the interest. So that is their right to receive that rate of interest, and to receive, if it is mentioned in that the certificate that you will receive the amount interest every quarter, then it is your right to receive the interest every quarter. Next is get back the amount invested. In the debenture document, they have mentioned that after 15 years, I'll be repaying your amount at a premium of 20%. So it is your right to get the amount at the end of 15 years. Before 15 years, you cannot ask the company to repay the amount, but after 15 years, it becomes your right. Next is you can go to the office of the company and you can ask them that you want to study the documents, because you have to make sure that your investment is safe. So for that you will see whether the company is working properly or not, and for that you can study their documents. Next is you can also get the information by depositing a fees, and this is also to determine the health of the company in which you have invested. Next is the company has prepared a trust deed. The company has appointed a trustees. So the trust deed, a certain provision will be given. In those provision, it will be mentioned how the trustees will work. That is, the trustees will meet once in a quarter. The trustees will take permission for XYZ items. The trustee will visit the site, factory sites, or the trustee will do a physical inspection of the asset. There are many rules and regulations which are given in the trust deed. So the debenture holder has the right to ensure that the provisions of the trust deed are followed. So in the annual meeting, whenever the debenture holders are meeting annually, at that time they expect the trustee to give them a full report on what all work they have done during the year. Next is right to appoint debenture trustees. So the first trustees will be appointed by the company, that is only for convenience. After that, the debenture holders can change the trustees. Next is that the board of directors have to take into confidence the debenture trustees before making any important decision. So for example, the company decides that these 3 factory sites which I have given as mortgage, but because I am running into loss and these factory sites are not feasible for me, I cannot continue operating them because I am incurring huge loss on them. So I need to close down these assets. So the board of directors cannot just take this decision because it is under mortgage. They cannot just close down this factory sites and sell off this factory sites. They will have to first take the permission of the debenture holders. They will do this through the trustees. The board of directors will go to the trustees. They will tell them that this XYZ asset is not feasible. We want to sell off or we want to close this factory site. The debenture trustees will ensure that okay, you are right, this is not possible. This is not possible to continue. So okay, you can close this asset. And after taking permission of the debenture trustees only, the board of directors can take this decision. Next is to ensure that the property which has been mortgaged is adequately safeguarded. Safeguarded means it is safe. For example, there is a natural calamity, and in that there is a possibility that the factory site may be destroyed, or there is some civil unrest, there is some strike or something. Because of this, the general public can come and destroy the factory site. So it is the right of the debenture holders that the company should take proper insurance of these factory sites. So even if something happens to them, even if it is damaged, even then the company will have the insurance money and company will can find a resolution. So their assets are basically properly safeguarded against any damage. Next is right to initiate legal action. So if the company violates any of the provision, if the debenture trustees violates any of the provision of the trust deed, then the debenture holder has the right to go to the court and start legal procedure. then they have the right to receive report regarding progress of the company. So because the debenture holder have to ensure that the company is working properly, that their money is safe, that the money they have invested they will receive at the end of 15-20 years. For that they will need a report from the company in which they are mentioning what are the things they have done in current year and what are the plans for the future. Next is rights to receive back money on priority basis at the time of liquidation. So in the second point we have already seen that right to receive money back, that was at the time of maturity, at the end of 15-20 years. But this is at the time of liquidation. That is, suppose before 15 years the company is closing down, the company is getting liquidated, then debenture holders will get their money back on priority. That is, before other shareholders, the debenture holders will be getting their money back. This we complete this session, and the remaining points, the remaining topics we will be seeing in the next session.